Jai Hind.
Right.
Good morning and welcome back to the next edition of Brick and Balance. Today we have with us an esteemed guest, Colonel Sunil Didi, who is a veteran in investments and financial planning. The topic today is insurance. We will start with the basic terms as to what all these terms mean, and I'll request Colonel Sunil to explain what are the various terms which are used in insurance, they mean in actual words.
Firstly, insurance is a mechanism to transfer risk. Now, a person who's earning his life is his asset, his health is his asset, he has a car, he has a house, all these are assets. Now, any of these assets can be damaged or destroyed, which causes a financial loss. Now, the person doesn't want to take this loss, he transfers this risk by paying a small money. And insurance company takes the risk. So when insurance company takes a life insurance risk, that means if the person dies, they will give a specified amount.
Yeah.
So one must take life insurance, health insurance, vehicle insurance. Your house should be insured. It's your biggest asset. Most people don't insure their house.
There was just a fire in one of the flats, and the entire household got burnt.
Correct.
Similarly for flooding.
Correct. So you have invested such a big amount. So you have to insure your assets, pay small amount. And the biggest mistake, so the subject is very vast, but within this, today we are going to talk only about life insurance, sir, because I don't think we'll be able to do
Yeah, we
justice.
will not be able to cover the entire gamut of types
Yes,
of
sir.
insurance. So let's start with the life insurance. So what are the types of insurance policies which are there when you talk of life insurance?
Sir, before we come to the types,
we'll get to the
we can cover
terms.
the terms. So one term which you must note is the something known as sum assured. Now, sum assured is the upper limit of liability that the insurance company is taking. So it's, let's say you are sum assured for a life insurance policy is 1 crore. So if the person dies, the company will pay 1 crore.
So there are some policies in which people have an insurance in case you are out of work for so many days, you will get this much pay.
Correct, sir.
So that is also part of this total sum assured.
Oh, no, sir. That is typically something known as a personal accident insurance policy. That clause comes there. So, and personal accident insurance is a type of general insurance.
Okay.
Which I feel everyone in the corporate sector must take. And it's a subject we need to talk about it little later, because today I think we need to restrict ourselves to this thing. The second term, other than sum assured, is the premium. Now, premium is the amount that the person who is getting insured needs to pay. So this is the amount which the company will take for covering the risk. After the premium, there is something known as premium paying term. For how many years will you pay the premium? So life insurance particularly, the time period of the policy is fixed. You can take a policy for 10 years, 15 years, 20 years, whatever you take. So the policy will be valid only till that time.
And I also request in this, subsequently, when you talk of term insurance, why we should take a term insurance at a particular age, and why should we have it till a particular age?
Correct.
Because the requirement at the age of 40, 50 is very high, and the likelihood of your next of kin getting benefited from it is very high when you are at 75.
Correct.
So I'll request you to cover.
I will cover, sir. So we were talking about a premium paying term. So premium paying term can be equal to the policy duration. Let's say you have taken a policy for 40 years. You can keep paying premium for 40 years, or you can have lesser than that. You pay premium for only, let's say, 10 years, 5 years, 20 years, whatever. Now,
but it will cover that period.
It will cover that period. Now, the point to note is, it is always beneficial for you to pay throughout the policy term. Now, a lot of people say, no, I want to get rid of it earlier. Do not get rid of it. I sold a policy for about 4 crores to a 27-year-old person. So he was wise to take a 4 crore policy because he could understand that much. he paid only 40,000 rupees. Now, if he had decided to pay lesser, he would have had to pay possibly 2 to 3 lakh rupees a year. Now, this extra money which you are not paying to the insurance company and you are retaining with you and you are investing, you get much higher returns.
Yeah, that's so. In brief, instead of having some insurance which is linked to your maturity and you get some money at the end, you are saying that if we have one part which is totally into insurance, that is term insurance,
Correct.
and the balance you put in investment proper, which is not
Yes.
insurance,
Yes.
like mutual fund or equity or wherever, or
Yes, sir.
property or whatever, you will get much higher return and much larger cover.
Correct, sir.
Okay.
So, you need to protect your money. Okay. Now, there are many times the insurance company representative, they will come and tell you, no, no, sir, you see the maths, you are paying lesser here. Do not get fooled, because numbers can be projected in different ways. Now, if somebody tells you something, make a note, get back to us, send a WhatsApp message, and we'll respond to you how you are being fooled. So, don't get mixed up. So, you must pay insurance throughout the term. Also, insurance companies will, now as a investor, you would like to possibly pay the premium every month, because you're getting salary every month. Paying a big amount once a year becomes a drain. Now, it's again mathematics. What these companies do is, they will charge you a larger premium if you are paying every month.
Okay.
So, unknowingly, you are paying more. So, all you need to do is, you need to, maybe for the first year, take out the premium, and for the second year, start saving now.
Do a recurring deposit, maybe.
Maybe RD,
Yeah.
or any overnight fund, arbitrage fund, anything.
Yeah.
Just let it go safe. 5-6% only if you are earning, but you are earning much more. And as you next year, just withdraw this money and pay the premium. So only once you have borne the pain, but you have saved about 4 to 5% this thing extra, which you will end up paying. So we covered sum assured, we covered
Premium, we have
premium. Yes, sir. Now let's come to the types of insurance policies. The types of insurance policies are, life insurance policies are basically 3 types. There's something known as endowment policy.
policy.
So, and in an endowment policy, the company will give you a part, will give you a bonus. Now, this bonus depends on the profits that the companies make. Now, my understanding is, most of these companies will never be able to pay you bonus equal to your PF rate.
That will be there. Yeah.
So, if you are getting, therefore, it does not qualify as an investment, because you can earn more in a PF. Now, the point to see is that, they sell it as a combination of insurance and investment.
I'll just button, like I have been a proponent of having a PPF for those who are not into government services or corporate. A PPF is generally in the range of 7 to 8%, depending.
7.1.
Today it is 7.1, it might go up a bit. So this is in the range.
Yes, sir.
Anywhere where you go, with the tax benefits which you get with PPF,
Correct.
you'll never get in any type of FD until as your interest rates in the country goes up to 10% or 12%.
Correct.
So it is a very, very good investment. And what you were saying, that instead of going for that endowment and other things, just go for term and put the balance into PPF.
Correct, sir.
You'll be much better off.
Correct.
Okay.
So we will come to term insurance, but endowment policy, we said that, mostly the agents tell you, you pay this much every year, and then after 5 years you'll get so much. At the end you will get so much. So the numbers look very large.
Yes.
The trick is, do not fall into that trap. Actually, you need to learn a formula which is known as XIRR. Put the numbers on that formula and calculate the return that you're going to get.
That's right.
In this formula, we're going to learn how to calculate returns. Now, the example that we have taken is of an insurance policy. Let's say somebody comes and tells you that, sir, we have this option where you can, you need to pay 2 lakh every year for 8 years, and then having paid 16 lakhs, you need to wait for 2 years, and then you will get some amount, let's say 26 lakhs. Now, how do I want to know what is the percentage return that I will get. So, for doing this, all I do is, you open an Excel file and I select 3 columns, date, amount and remarks. Now, first I need to format these cells. So what I'm going to do is select the column of date by first clicking on the left side of the mouse on column A, and then I right click it and these options open. I will select format cells. It will initially be at general, so I need to select date, and I select the date format that I want to. Let's say I want to select this format, so I select this and I say OK. So this is the amount. Now I need to format the column for amount also. I left click it, right click, come to format cells and come to, from general I come to number and then select, I can select decimal places 2, 4, whatever, or 0 decimal also. So I'm going to select 2 decimals and then I say OK, and remarks is a text column, so I'm not going to worry about it. Now let's say my first premium I paid is on 20th of June 22. I paid 2 lakh rupees. Now the rule to remember here is, in XIRR, any amount that is going out of your pocket or your bank that is getting invested will be entered with a negative sign, and any amount that is coming back to you from that investment to in your bank or your pocket is written with a positive sign. So because I have paid this money, so therefore it is with a minus sign. Now I select this, I copy this like this. So the same date has got copied, but I want to change the dates. So I just select this and I select fill years. Now what has happened is, on the same date, the years have changed. However, we need to change the last date from 30 to 32, let's say. The amount will remain same, so I can just copy it up till the time I am paying, and premium also will remain same. Now the last one is my maturity benefit. So this is the amount that is going to come back to me, and let's say I am getting 26 lakhs. Now because this money is coming back to me, I write it with a positive sign and I want to find out the returns. Now for calculating the returns, what I am going to do is I am going to use the XIR formula. Now in Microsoft Excel, whenever you want to write a formula, you have to start the formula with is equal to sign. So I write is equal to, then followed by XIRR, and then I open the bracket. It is telling me to select the values. So I select all these values, all the amounts that have gone from my bank and come back to my bank, followed by comma. Now I select dates. So I select dates and I close my bracket and followed by into 100. Now in Excel, into is represented by the star symbol, so I enter star and 100 and then I enter and I find out that my returns are 7.52%. So what looked like a very good investment is actually not that good. Now you can use this formula for calculating returns from your insurance policies and from your property. Let's say you buy a property, you give initial amount and then pay some more. You start paying EMIs and then you start getting some rent and finally sell it. So you can put all those numbers with dates and you can calculate the returns. Now the agent is trying to sell you a policy. He can sell you by telling you 20% also. You should not fall in the trap. When the policy document comes to you, you have to read.
Yes.
There's a friend of
that is the reason they make a policy document in 60-70 pages.
And the font size is so small, sir,
that you are dissuaded from reading it.
Correct. So a friend of mine who's today a Lieutenant General, he sent me he told me that my agent is telling me that I'll get 8.5% guaranteed returns. I said not possible. This is about 4-5 years back. I said impossible. He said no, he's given me a document. I said share the document. So now in that, there were 2 stars next to 8.54. So I went for the stars. Now what it said was 8.54% of the sum assured.
Okay.
Now you must try to understand. You are paying a premium. Whatever returns you are going to get should be on this premium and not on the sum assured. Sum assured and premium, how are they linked? You don't know. So if you are paying 100 rupees and you are getting 8.5% on this 100 rupees, it makes absolute sense. But they will tell you on sum assured, so therefore please don't fall in this trap. So endowment policies don't make any sense whatsoever. The next type of
And
insurance,
this is the policy which the insurance agents try to
yes, it is
push
the
maximum,
maximum.
because you, with that lure of earning at a particular time in life, you keep paying the premiums, and
Correct.
he keeps getting the cuts from that
Correct, sir.
commissions.
Now, something I wish to highlight here, we are both of us are saying the same thing over and over again. Do not invest in insurance. So, why should you trust us? So, firstly, there are two resources that I'm going to share. First is an article by Economics Times Wealth, which said that 10 financial mistakes you will regret at age 50. So, we'll post the link also in this.
Okay,
One can watch a this thing article there. So, it says, people are trapped. So the article says that most policies, they bind you into a multi-year contract where the returns are just about 5 to 6%. This part one. The second is a booklet by RBI, which is called Financial Awareness Messages. And again, you can just ask for it, or you can download it from my Fauji Wealth website. You can just download it. Now, in that also it says that, when you go to a bank, the picture there says that, investor goes to a bank and says that I want to open a FD. The bank manager says, I suggest you take a policy.
Yeah.
So the RBI caption says that do not mix insurance and investment. And this is where I want to highlight that, banks are your biggest culprits, because over a period of time, the banks, particularly bank managers, they try to make a bond with you. Oh, because you're going to same branch again and again. So they tell you, sir, this is a very good policy. Please do not fall in the trap. It is a bad thing.
That's right.
Now, the second type of insurance policy is called something called ULIP. It is called Unit Linked Insurance Plan. Now, in this policy, what they'll tell you is that you give us the money, and our company will invest it in stocks, in share market. You don't have to do anything, and we will deliver you 12, 15, 20%.
So basically, it has got two parts. Like if you are putting, say, 20,000 rupees in that, so 2-3,000 rupees will be covering your insurance, and those 15, 16, 17 will go towards investment.
Correct, sir.
So they are able to cover a bit bigger amount,
Yes, sir.
yet not good enough, and they invest so that you feel that at the end of the day, I'll be earning better than an endowment policy.
Yes, sir.
And it has got some tax benefits also.
Yes, sir. Now, firstly, tax, let us forget for the time being. But let's only focus on the returns. Because tax you will pay only on part of the returns.
Yeah.
So your aim should be maximizing returns. Now, I'm going to show a policy, and this policy was taken by a young officer who was 20 years old when he took the policy. And he was told that he needs to pay 2 lakh rupees per annum for 8 years.
Okay.
And the policy tenure was 10 years. He took it 22. Policy was valid till 32. He pays 2 lakh rupees every year for 8 years. And the best part was when you see the first policy receipt, out of the 2 lakh rupees paid, almost 24,000 has been deducted by the company as charges, 12%.
Oh my God.
12% in the first year. Now, if you see the charges over the 5-year period, it comes to an average of about 6.4. Now, here is the catch. If he has taken 12% to just give zero returns, now he has to give much higher returns.
At least 15-18%.
Correct, sir. And this is what most people don't realize. So, I give an example. Let's say, the company says, let's say charges are 7%. You pay a premium of 1 lakh. The company says you will get 15% returns. But you get 7.5%. Now, how's the disconnect? The disconnect is they are deducting 7%. So 1 lakh premium paid, 93,000 is getting invested. This 93,000 is giving you 15% returns. You are getting 1 lakh 7,000. So your returns are only 7%. Even if the company gives whatever, it is the returns that you have earned. So ULIP, again, the charges are very high, and therefore does not make sense. Also, the sum assured in ULIP is usually 10 times your premium paid.
Okay.
So again, somebody is paying 2 lakh rupees and is getting a sum assured of only 20 lakhs.
It's nothing.
It's nothing, even today.
Yeah.
And just imagine what's going to be the value after 10 years.
Yeah.
So therefore, does not make sense. The best kind of insurance which is available is term insurance. It's a pure insurance. Most people don't understand it. So, in simple words, a term insurance is a policy which is like your car policy or your bike policy. You pay the premium and nothing happens to your car or bike at the end of 1 year. The premium paid earlier goes down the drain and you have to pay premium all over again just to renew it. So this is the problem. So term insurance, what it does is it will give you for a very small sum assured, it will give you a large life cover. Now, how much cover should you take? Sum assured, how much should you take? A lot of people think that maybe 1 crore is a magic number. I'm sorry, that's not the case.
That's not.
So it depends on for how long are you looking. For example, I mentioned that there was somebody who is 27-year-old and he was earning a very good salary, and he agreed that yes, I need to take at least about 4 crores because after maybe 10-15 years 1 crore will have no value.
And some of these term insurance have a system of you can keep increasing the insured
Yes,
value.
yes, sir.
That is again a good thing.
That's the thing. So term insurance is the best policy. Again, we have done this calculation where I mentioned about the young officer paying 2 lakh rupees, and we said that let's say if he had taken a term insurance of 20 lakhs, so his premium would have been just about 4,900 rupees.
That's right.
So the balance amount gets invested, and I'm going to show you the calculations. We've done calculation at 7%, 10%, and 12%. 10 and 12% of obviously coming from mutual funds. And you can see how much
the way
extra
it
money,
compounds.
yes, over a period of 10 years, how much extra he could have made. So now one policy which is not known to most people is something known as Pradhan Mantri insurance policy.
Yeah. And then
So there are two policies, Pradhan Mantri Jeevan Jyoti Bima Yojana and Pradhan Mantri Suraksha Bima Yojana. Nobody tells you about it because nobody gets a commission out of it.
yes,
So
and it's very, very cheap.
it's very cheap, it's dirt cheap. So you get Pradhan Mantri Jeevan Jyoti Bima Yojana is a life insurance policy. You get a sum assured of 2 lakh rupees. It's not very big amount, but the premium you are paying is just about 436 rupees. And the accidental insurance, Pradhan Mantri Suraksha Bima Yojana, that again has a sum assured of 2 lakhs, but the premium is 20 rupees. So
And where do you get this from?
just go to bank.
That's
Wherever you have an account, just go there. Everyone in the age group of 18 to 50 needs to sign up for these policies.
You must.
You must. And you have to tell everyone you know, your brothers, sisters, your family members, your subordinates, your cooks, drivers, everyone needs to have this.
That's right. Especially the weaker strata of the
Yes, yes.
society, they must have it
They
because
mu-
a medical cover of 5 lakh is massive.
Yes, sir. So, but this is not a medical cover, sir. This is just a pure life insurance cover.
वो जो जीवन सुरक्षा वाला एक the second one which covers
No,
the
that is personal accident, sir.
personal accident. Yeah,
So
that's
personal accident will pay you if you if you suffer accident and there is a disability.
invalidated type. Yeah.
So 50% disability, they'll possibly give you 1 lakh rupees.
Okay.
But at least even that is a big amount.
That will at least look after you for getting back into something.
Yes, yes.
Okay. And one thing which term insurance, I would like to explain how much term insurance should we take. There is a rough thing which goes on the market that whatever is your salary, 100 times of that should at least be insured, is one way of looking at it. Then the second thing is at what age you should take. So some school of thought is that if you have a liability, I would not say liability, but there's a dependency on you, that is your wife or your children, then in case you are not there, how will they be looked after, how much money will be needed, and how do you calculate it? That is very important. And similarly, when you are in the say 50 age group of 50, 55, when your children are likely to go to college or university or go abroad for studies, how much money will you need? So that aspect has also to be covered. I'll request you to cover a bit of that, as also what decides, like if I say I want to be insured for 200 crores, obviously the insurance company will not give me that. So how it is calculated, I'll request you to give that also.
So what some companies do is that if you can take up to 10 times your annual income.
Okay.
Now, another company will come with a clause that, okay, if you are below 45, they will even give you 20 times your annual income.
Mm.
So, whatever is your annual, let's say somebody is earning 1 lakh rupees a month. So, 12 lakh rupees is the annual income. So, he can take 1.2 crores if he is above 40, and if he is below 40, he can take 2.4 crores.
Yeah, because the mortality now is somewhere around 70 for men
Yes, sir.
in India.
Yes, sir.
So that's why they will benefit for the next 30 years or something,
Correct, sir.
because the mortality rate is quite low and
Yes,
the
sir.
life expectancy is increasing.
Correct, sir. Now, when should you take the policy? So there was a friend of mine. His son was, somebody came and said, take a term insurance for him, and he just reached out for a second opinion. I said, why? He just picked up the first job after college. So I said, is he not going to do masters? He said, yes. So I said, you don't need term insurance now. You will need term insurance when he gets married.
Yeah, that's right.
When he has dependents.
Yeah.
So that those dependents are not,
Left high and dry in case of any
absolutely,
mishap.
sir, absolutely. So therefore, one should not take too early also.
Yes.
But when you have dependents, you must take. For how long should, again, lot of people, when I deal with mostly soldiers. Now, a lot of in army, people retire at 54. And at 54, in many cases, the children are not settled. They are in college. Now, they are still dependent on you. And therefore, if you are not taking re-employment, then you need to take term insurance. And you need to take it at least 2 years before. Now, this is a clause, sir. Why 2 years before? If you take it at the time of, just about before quitting, then your policy claim is likely to be rejected.
Okay, why?
There is a clause of, there's something called utmost good faith.
Okay.
Because insurance is a contract between the person taking insurance and the insurance company. Now, the insurance company says that you pay the premiums, and if you declare everything truthfully, we will pay the sum assured. So, this is a contract from the company side. This person says, yes, I will pay the premium and I'll declare everything truthfully. Now, another clause is that term insurance is only given to those who have a salaried income.
Okay.
Salaried or business income, but income has to be there. Pension is not counted as salary.
Okay.
So, let's say you take it just before retirement. What you are doing is effectively you are concealing that you are going to retire. And when you conceal that you are going to retire, so the company will say he lied to us.
Then will go to litigation.
And the case will be thrown out, and it will be proved that yes. And therefore, when you take a term insurance, you must declare your habits, like whether you smoke or you don't smoke, whether you drink, how much do you drink, all kinds of things. Your health, your family health history, everything must be declared completely truthfully. Because the moment you are declaring anything false, the case will likely to be. Now, why 2 years I said is because let's say somebody takes a policy today and he retires after maybe 2 years and 1 month or so. So when he retires, he would have paid 3 premiums.
Okay.
Now, IRDA regulations say that this is the period that the company is getting to verify all the claims, that all the information that you have shared, to verify that. Earlier, what used to happen, you declared, and company after 5 years would say, no, he lied to us.
Okay.
So now IRDA says that no, you can't do it forever. First 2 years is only 2 years.
It's like you can return the policy in the first 45 days or 60 days.
So yes, that is, there is something known as free look-in period.
Free look-in, yeah, that's right.
So if you have been sold a policy and you don't understand, or maybe you have been sold a wrong policy like endowment policy or a ULIP, just go and return that policy. You will be charged the premium only for those whatever days, 10 days, 12 days. But you will get the money back and you will not get trapped. Now, term insurance, if you take now, and let's say first 2 years you are in service, so it is covered. And thereafter, even if you are quitting, you retire or you take PMR, it does not matter, because then the company will pay the premiums. So
that's right. So we have generally covered most of the things.
Yes, sir.
And there are certain insurance which are not applicable in India. Like abroad, you have got a burial insurance also, for information. So because the burial cost is very high.
Sorry,
there's an insurance for burial.
Okay.
So when the guy dies, he needs a cemetery.
Okay.
to be buried.
Correct.
So the cost of that is also covered by that.
Okay.
And one thing which, apart from what we had discussed, like you should always cover your future payment liability also by insurance. Just like when you take a home loan, it should always be covered with an insurance policy.
The housing loan is a big liability. You buy a house, let's say worth 1 crore. Now 80 lakhs is the loan that typically people are taking. Now this 80 lakhs is a big amount, and therefore you must firstly take an insurance for yourself for 80 lakhs. Now many of these companies will tell you that, okay, we can insure this amount. That God forbid something happens to you, you will not have to pay. That is insuring the loan amount.
Loan amount.
Now I suggest that you take a term insurance. The difference between the two is it's just a fine difference. Your loan amount keeps decreasing over a period of time. So the company's liability keeps going down. Whereas if you take a term insurance for 80 lakhs, let's say after say 10 or 15 years when the person dies, the loan amount is only 20 lakhs. Now you pay 20 lakhs to the company, 60 lakhs is available to your family. Now again, how much sum assured if you should take is, it is at least 20 times your annual income.
But I think there will be one little difference, because if suppose I want to take the maximum eligibility I have in terms of term insurance. So suppose my eligibility is fixed at 2.5 CR. So if I want to take that and I want to take this also, that is the housing loan.
Correct.
Then I can cover a bigger amount.
Yes.
So my family gets those 2.5 CR.
Yes, correct.
And that paid is also.
Absolutely,
So
absolutely.
That is one option.
The
premium goes up. That is it.
Premium you will have to pay, sir. But the issue is that how many people actually take the ideal term insurance?
Yeah.
Very few people actually take the ideal term insurance because it means paying, and that paid money is going down the drain.
So how much you feel is the ideal term insurance? Around 10 times the annual income?
Sir, I think little more. The reason is that let's say somebody is insuring, has a term insurance for 1 CR. Now 1 CR looks very good. Now what are you going to do with you? And again, I want to add one more thing. As a friend once told me, and that had me thinking, that even after taking a term insurance, the family will still not be able to lead a happy life. The reason is the family has not seen such a large amount
using it,
and there will be so many the people on whom they will rely, their friends and relatives. Firstly, they may not be qualified to help them put that money safely and generate an income out of it. Secondly, people have vested interest also. What can can I borrow a loan out of this because this lady is getting such a large amount? So before you take it, when you take a term insurance, you must also have a written plan what your wife should do or what your spouse should do, where this money is to be invested. Because if you don't put that down,
that's right.
Okay, now let's say somebody is taken an insurance of 1 CR. What we are trying to do is we are trying to generate an income out of this while keeping the principal intact. And therefore, the returns that you should take is not more than 6 to 7%.
That's right.
So you generate about at least 10%, 10 to 12%, and you are earning 6%. You are using 6 to 7%. The money keeps growing while sustaining you. And so if you take a 6% return, or let's say 7%, 7% return on 1 crore is just about 59,000 rupees a month. So 1 crore looks very good, but 59,000 a month. And again, 59,000 a month today, after 5 years, if you still give 59,000, it's going to be no use.
So we can say in a different manner that if your income is say 1 lakh rupees a month and the main earning member is no more. So the way pension is paid is that if your pension is 1 lakh and the pension earner dies, then the spouse gets 60% of that.
Correct.
So if the earner is no more, then you actually need around 60% of that money
Absolutely.
to survive comfortably. So how do you generate that 60%? So if you are earning 1 lakh, getting 60,000 per month, how much you insure? You do a backward calculation.
Exactly.
And I think if you insure that much, you will be
then you are okay. Then you are okay. And not this is just the basics, but you need to calculate that maybe you have a housing loan. Maybe you need to factor in other things that let's say you don't have a house. Where will the family stay? The rent will keep increasing. So many cases what happens is the term insurance amount comes, the family says first thing I should do is buy a house,
Buy a house.
which possibly is not needed at that stage. You can still survive in a rented accommodation. But these are the mistakes. The money handling is equally
Money
important.
handling is very important. So it is a normal saying that it is easier to earn money than to
Manage it.
hold it and manage it.
Correct.
And you see it worldwide. So many ultra rich film stars, ultra rich businessmen, they've gone down the drain, including one of the biggest ones called Ambani's,
Yes, sir.
one of them. So it is not surprising that a normal person goes into the wrong lane.
There's this once they saw this thing. There's a gentleman called Sushil Kumar. He got a prize of 5 crores from Kaun Banega Crorepati,
Okay.
and then he became a pauper. So it's a typical case which he talks
Rags
that
to
how-
riches to rags.
rags to riches to rags, absolutely. So absolutely low middle class person getting 5 crores and then losing everything.
It happens.
So that is what.
So I'll request you to sum up the complete thing.
So in today's episode we talked about life insurance in particular, and the life insurance, there are 3 type of policies: endowment policies, ULIP, and a term insurance. In ULIP and endowment policies, you are investing also. That's a bad idea. Do not invest in insurance policies ever. So take a pure term insurance and the premium goes down and the balance amount you invest. So don't mix up insurance and investment. Take the correct insurance amount. Have a plan ready so that God forbid something happens to you, the family, if it follows that plan, they will never have problem of cash anytime. Children's educations, higher education, weddings, the retirement income for the wife, even when children, let's say, don't
So
support
taking
her.
insurance is one part. Planning what will be done with that
Yes,
is the bigger part.
it's a bigger part. Yes.
So we had a very fruitful discussion on insurance, like basically life insurance, and I'll thank Kansulil Didi for bringing out in a very, very simple and grounded manner as to what we should go in for and what we should avoid. I'll conclude this and I'll request you to like and subscribe Brick and Balance. Thank you. Jai Hind.